Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. SaaS company loans. Software as a service, SaaS, companies are rapidly expanding across the business world, making it essential for entrepreneurs and investors alike to understand SaaS company loans. These types of loans provide an essential form of financing that allows SaaS businesses to grow and scale with the increasing demand for software solutions. In this guide, we'll highlight the main aspects of SaaS company loans and how they can help businesses thrive in a constantly evolving landscape. Understanding SaaS company loans. When it comes to financing your SaaS business, you have a variety of options to consider. It's essential to understand the differences between these options to make an informed decision that best suits your company's needs. Debt and equity are the two primary means of financing a SaaS business. With debt financing, you borrow money from a lender, repay it over time, and retain full ownership of your company. Debt financing can be useful if you prefer to avoid diluting your ownership stake. Common types of debt financing for SaaS companies include venture debt and term loans. On the other hand, equity financing involves exchanging a portion of your company's ownership for financial investment. This can come from venture capitalists, angel investors, or even friends and family. Equity financing is a popular choice for many SaaS companies, as it allows for a more flexible repayment structure and aligns the investor's interests with the growth of the business. SaaS financing refers to financial options specifically designed for software-as-a-service businesses. This type of financing typically takes into account the unique aspects of a SaaS company's business model, such as recurring revenue and subscription-based pricing. Some examples of SaaS financing options include revenue-based financing, where a lender provides capital in exchange for a percentage of your company's future revenue, or lines of credit that take into account your company's monthly recurring revenue. Here are some pointers to consider when looking for SaaS company loans. Assess your current financial situation and project your company's growth to determine the amount of funding you need, and the type of financing that is most suitable. Research various financing providers and their requirements, as some may have specific criteria related to the size, revenue, or profitability of your SaaS business. Understand the terms and conditions associated with each financing option, including interest rates, repayment schedules, and any additional fees. Consider the long-term implications of your financing decision, such as how it will impact your company's valuation, growth potential, and future funding opportunities. Ultimately, choosing the right financing option for your SaaS business comes down to your specific needs and preferences. Consider all your options carefully, and select the one that best aligns with your company's goals and growth trajectory. Types of SaaS company loans. When considering financing options for your SaaS company, it is essential to understand the different types of loans available. Each option has its advantages, depending on your company's size, stage of growth, and funding requirements. Venture capital firms provide investment to startups with high growth potential, often in exchange for equity. If your SaaS business has a strong business model and a clear path to profitability, venture capital could be an ideal choice. Keep in mind that accepting venture capital may involve giving up partial ownership or control of your company to investors. Equity financing is another common option for SaaS companies, as it involves raising capital through the sale of shares. This means that you will not have to repay the funds, but rather provide investors with a portion of your company's future profits. If your company is in its early stages and has not yet generated significant revenue, equity financing might be a suitable choice. Revenue-based financing. This type of loan involves receiving funds based on monthly recurring revenue that your company generates. As your sales increase, monthly repayments grow proportionally. If your company is experiencing steady growth and predictable revenue streams, revenue-based financing could offer flexible repayment terms suited to your cash flow. Venture debt is a form of debt financing that is specifically designed for startups and high-growth companies. It provides access to capital without having to sell equity, making it attractive for businesses seeking to maintain control. Venture debt is typically used in conjunction with equity financing to fund specific projects, such as expanding operations or launching new products. Before making a decision, it is crucial to carefully weigh the pros and cons of each option and assess how each type of loan aligns with your business objectives. Additionally, consulting a financial advisor or accountant can be useful when considering various financing options, to ensure that you select the best path for your SaaS company's growth and success. How to qualify for a SaaS company loan. To qualify for a SaaS company loan, you will need to meet specific criteria based on key financial and growth metrics. The most important factors that lenders look for when considering your application are your monthly recurring revenue, MRR, and annual recurring revenue, ARR. Your MRR and ARR are significant indicators of your company's financial health and predictability of your cash flow. Ensure that your MRR and ARR figures demonstrate consistent growth over time, as this will make your application more attractive to lenders. Another important factor for qualifying for a SaaS company loan is demonstrating a consistent revenue stream. Briefly, lenders look for companies with a stable and growing user base, as this is a good sign that your business model is viable and has market demand. Make sure to showcase your user growth rates and retention metrics as part of your loan application. In addition to the financial metrics mentioned above, lenders may also consider your company's user base before offering a SaaS loan. A strong and loyal user base can help convince a lender that your business is sustainable over the long term. To improve your chances of qualifying for a loan, ensure that your user base is growing and that your customers are engaged with your product. Lastly, to qualify for a SaaS company loan, you may need to have an active SaaS account with the lender or a third-party finance provider. This account acts as a financial record and track record of your company's performance. Before applying for a loan, check the requirements of the lender or financial institution to ensure that your business meets their eligibility criteria. In summary, to qualify for a SaaS company loan, focus on showcasing your company's consistent and growing MRR, ARR, and user base while maintaining an active SaaS account with the lender or finance provider. By demonstrating your business's strong financial performance and sustainable growth, you are more likely to secure the financing you need to support your company's future success. Key players in SaaS company financing. As you navigate the world of SaaS company financing, it's essential to understand the various key players involved. These entities can provide invaluable financial support to help you grow and succeed in your industry. Let's explore the main players in SaaS company financing and their roles. Banks are traditional financial institutions that offer various types of business loans and credit facilities to SaaS companies. Bank loans for SaaS businesses may require collateral, have fixed repayment terms, and come with covenants related to your company's financial performance. While banks can provide considerable financial resources, they may not always be the most flexible option for your specific needs. Incubators are organizations dedicated to nurturing early-stage SaaS startups by providing resources such as mentorship, office space, and business expertise. In some cases, incubators also provide financial assistance, usually in the form of grants or seed funding. Becoming part of an incubator can be an excellent way to access valuable resources and industry connections, along with potential financial support. Angel investors are high-net-worth individuals who invest their personal funds into promising SaaS startups. Often, they offer not only financial backing but also mentorship, strategic advice, and industry expertise. The typical investments from angel investors can range from small amounts to significantly larger sums, depending on the investor's interest and capacity. Accelerators are programs that provide selected SaaS startups with funding, mentorship, and critical resources to rapidly grow their businesses. Like incubators, accelerators aim to develop participating companies and prepare them for the next stage of growth. In exchange for their support, accelerators usually take a percentage of equity in your company. Institutional investors include venture capital firms, private equity firms, and other large financial organizations that invest in SaaS businesses. These investors often have significant financial resources and industry expertise, making them valuable partners in your growth journey. Institutional investors typically invest in later-stage SaaS companies with established revenue streams or strong growth potential. Super angels are a unique class of angel investors with a record of successful investments in the SaaS sector. They often dedicate substantial amounts of capital and commit to multiple investments, differentiating themselves from traditional angel investors. Super angels can provide valuable industry connections, substantial financial support, and strategic guidance to your SaaS business. Understanding the roles and contributions of these key players in SaaS company financing can help you make the right decisions for your business's growth. Evaluate each option based on your needs, stage of growth, and long-term goals, allowing you to secure the financing that best suits your SaaS company. The process of SaaS company financing. When you embark on the journey of financing your SaaS company, you should be aware of the various options available to you. Initially, it is essential to pinpoint your funding needs and align these with the ideal financing type. Some main funding entities you might encounter include equity, debt, Series A funding, Series B funding, and non-dilutive financing. Equity financing involves selling a portion of your company's ownership in the form of shares to an investor, who will typically provide you with capital in return. This can be an attractive option if you want to maintain control over how the funds are spent, and benefit from the investor's expertise and network. However, it also means sharing future profits and making joint decisions with the investor. Debt financing, on the other hand, involves borrowing funds from a bank or lender and repaying it over time with interest. This approach allows you to retain full ownership of your company, but it may put more pressure on your cash flow due to the repayment obligations. A viable option could be exploring a tailor-made debt product for SaaS companies that caters to your specific business needs. Series A and Series B funding are further stages of equity-based financing, following the seed funding stage. Series A funding is primarily for companies with some initial success in the market and aims to fuel scaling and expansion. Series B funding, conversely, focuses on business growth and is navigated by more established companies with a successful sales model and increasing revenue. Lastly, non-dilutive financing refers to acquiring funds without impacting your company's ownership structure. Examples include grants, loans, and revenue-based financing. In particular, revenue-based SaaS finance providers usually require access to your company's back-end systems, like Stripe, to analyze revenue and determine your financing eligibility. In conclusion, the process of financing your SaaS company involves a careful evaluation of your business needs and the available funding options. Understanding these entities will enable you to select the ideal path for growth and success. Exploring debt options for SaaS companies. As a SaaS company owner, you have several options when it comes to funding your business. The debt landscape for SaaS companies can be complex, but understanding the key differences between various debt options can help guide your decision-making process. In this section, we will briefly discuss venture debt, revenue-based financing, and other debt options that may be suitable for your company. Venture debt is a popular choice for SaaS businesses, particularly those with high growth potential. This type of debt is typically offered by specialized lenders or venture capital funds, and is designed to complement equity financing. Venture debt can provide the additional cash runway needed to create equity value for shareholders without diluting ownership. To secure venture debt, you may need a strong business plan, healthy recurring revenue, and an established VC relationship. Revenue-based financing, RBF, is another alternative suitable for SaaS companies with predictable and growing revenue streams. In this model, businesses borrow against their future revenues, allowing them to access funds faster than with traditional loans. RBF loans generally have a repayment schedule tied to your company's revenue growth, making them an attractive option for SaaS businesses that experience seasonal fluctuations or have lumpy revenues too. To qualify for RBF, you may need to demonstrate stable recurring revenue, low churn rates, and strong unit economics. In addition to venture debt and RBF, the debt market for SaaS companies also includes term loans. These loans are traditional fixed-term financing options, where you borrow a lump sum and repay it over a specified period, usually at a fixed interest rate. Term loans can be an attractive option for established SaaS businesses with stable revenues and strong credit profiles. 3. MRR-based credit facilities, also known as monthly recurring revenue (MRR) financing. These facilities allow SaaS companies to borrow against their consistent subscription revenues, providing flexible financing to support growth and operating needs. It's essential for you, as a SaaS business owner, to carefully consider the advantages and disadvantages of each debt option, taking into account your company's specific needs, financial position, and growth objectives. By thoroughly exploring and evaluating all these options, you can make an informed decision and choose the most suitable debt solution to support your SaaS business. Equity financing in SaaS companies. When starting or growing your SaaS business, you'll likely need funding to cover various expenses and investments. One of the options you should consider is equity financing. This involves raising funds by selling shares of your company's ownership equity to investors. Equity financing has distinct advantages for SaaS companies. Firstly, you typically don't need to make regular repayments or incur interest costs, unlike with debt financing. As your investors share in the ownership of your company, their reward comes from their proportional share in profits or an increase in the company's value. This can help you focus on your growth strategy rather than servicing debt repayments. By selling shares in your company, you'll likely attract investors with relevant industry knowledge, expertise, and connections. These investors can provide guidance, valuable insights, and introductions to potential partners, clients, or additional investors. In this way, equity financing can add more value to your SaaS business beyond the initial monetary investment. However, you should be mindful when deciding on the percentage of ownership equity you're willing to sell. In doing so, you'll be giving up a portion of control and decision-making authority, which may affect the direction of your company. It's essential to find a balance between the funds you need and the level of ownership and control you're comfortable with. With SaaS companies being highly valued in today's market, equity financing can provide significant growth potential. As your company builds a loyal customer base, your recurring revenue stream can make your business more attractive to investors who see the potential for long-term growth and returns. To summarize, equity financing can be a powerful tool for SaaS companies looking to grow and scale. By offering investors a share in your company's ownership equity, you gain access to their expertise, connections, and funding without the burden of immediate repayments. Carefully considering the pros and cons, as well as the percentage of equity to offer, will help you make an informed decision when using equity financing for your SaaS business. Importance of a funding plan in SaaS businesses. A well-crafted funding plan is crucial for the success of your SaaS business. It provides a clear roadmap, outlining how you will obtain the necessary financial support to develop and grow your venture. In the fast-paced world of software as a service, having a solid plan in place is essential for staying ahead of the competition and achieving long-term sustainability. One of the primary reasons for having a funding plan is to ensure that you can allocate resources effectively to research and development. This is particularly important in the SaaS industry, where constant innovation and development are necessary to stay relevant and meet customer demands. By identifying potential funding sources and drafting a comprehensive plan, you can ensure that your business has the financial backing it needs to thrive and grow in a competitive market. Another critical aspect of a funding plan is that it helps you align your SaaS business with the right financing options. There are various SaaS funding alternatives available, including bootstrapping, venture capital, crowd-funded equity, and government grants, among others. Being aware of these options and having a strategy in place allows you to choose the most suitable funding sources for your venture. Your funding plan should also include financial projections and an in-depth analysis of your SaaS business model. This information is essential for potential investors, as it allows them to assess the viability and profitability of your venture. A robust funding plan with projections and relevant data will also enable you to identify any potential obstacles or challenges ahead of time, allowing you to plan accordingly and ensure your business remains on a steady growth path. In short, having a funding plan in place for your SaaS business is crucial for long-term success. It enables you to allocate resources efficiently, align with the most suitable funding options, and provide potential investors with the information they need to assess your venture's viability. To give your SaaS business the best possible chance of success, ensure you have a comprehensive funding plan in place early on in your journey. Closing remarks. Attaining funding for your SaaS company is a crucial step towards ensuring its success, and understanding the available options can make a significant difference. As a seed-stage company in the B2B space, it's essential to have a thorough grasp of the available loan options and the potential benefits and impacts on your business. One option worth considering is SaaS Capital, which offers tailored debt financing solutions for SaaS businesses. Their expertise in the field, coupled with flexible terms and conditions, can help you secure the right type of funding for your business. As you navigate the world of SaaS company loans, don't overlook the value of mentorship. Connecting with experienced professionals in the SaaS and financing industries can provide valuable insights and guidance, helping you make informed decisions. Lastly, always remember that maintaining a confident, knowledgeable, and neutral approach to financing will not only help you find the best solution for your business, but also build a strong foundation for future growth. Now it's up to you to take the necessary steps, do your research and secure the funding your SaaS company needs to thrive. Good luck on your journey, and remember that a well-informed decision is the key to your success. What are the key factors for obtaining a SaaS company loan? When applying for a SaaS company loan, it is crucial to consider several factors such as your company's credit score, cash flow, financial history, and projected revenue growth. Additionally, having a solid business plan, a strong management team, and a scalable product can help you secure the loan. Make sure to present these factors accurately and persuasively to potential lenders. How can I secure funding for a SaaS startup? Securing funding for a SaaS startup can be challenging, but there are several options available. You can consider venture capital, angel investors, or crowdfunding platforms, depending on your business requirements and growth plans. Additionally, explore non-dilutive financing options, such as SaaS finance products that offer capital investment without requiring you to give up equity in your company. What are the best finance software options for SaaS businesses? Choosing the right finance software for your SaaS business largely depends on your company's size and specific requirements. Some popular options include QuickBooks, Xero, and Zoho Books. Each software offers varying features and capabilities, so it's essential to evaluate different options and select the one that best caters to your financial management needs. Are there specific loan options for financing SaaS companies? Yes, there are specialized loan options designed to cater to the unique requirements of SaaS businesses. One such option is revenue-based financing, which considers your company's future sales projections as a basis for lending. This funding solution allows your loan repayment to match your company's revenue growth, without requiring personal guarantees or collateral. You can explore different debt options for SaaS companies to find the best fit for your business. What role does revenue growth play in SaaS lending? Revenue growth plays a significant role in SaaS lending, as it gives lenders confidence in your company's potential for long-term success. Consistent and strong revenue growth signals that your business has a scalable product and a sustainable business model. Most SaaS lenders will carefully assess your company's historical and projected revenue growth, alongside other financial and operational metrics, to determine your loan eligibility and terms. What types of investors typically support SaaS businesses? SaaS businesses can attract various types of investors, depending on their stage, market, and growth potential. Common investors include angel investors, who typically invest during the early stages, venture capitalists, who invest in high-growth startups, and private equity firms, who may invest in more established SaaS companies. Additionally, alternative funding sources like revenue-based financing and SaaS-specific loans cater to the unique needs and growth patterns of SaaS businesses. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.